Hi, Tim Kerrin here from Mortgage Choice in Kingsley. It's time to give you an interest rate update. If you don't have a home loan or you're not interested in getting one, then now's probably a good time to stop watching because I'm just going to be talking about interest rates. If you do have a home loan or you are thinking about getting one, this is probably going to be quite interesting. So we have seen interest rates fluctuate in a pretty interesting way since COVID happened. A quick background, I guess, in summary of the last couple of years would be that rates were around the 3% mark before COVID hit. When COVID hit, fixed rates dropped by, over the course of 2020, about 1% and got down to about 2%. Variable rates trickled down with them to the point where now a good variable rate is around the 2% mark. The other thing that's happened during that time, though, is variable rates have split across different loan-to-value ratio bands. So if you're borrowing less than 50% of the property value, you can get a better rate with some lenders than if you're borrowing between 50 and 60% of the property value. And then 60 to 70, 70 to 80, 80 to 90. Some lenders offer different rates across all those different bands. Some lenders just offer different rates below 80% and above 80%. So that can make a difference to how much interest you're going to pay. If you're at 80% or below, I think it's a fair statement now to say variable rates are significantly cheaper than fixed rates. A lot of lenders' fixed rates are now in the mid to high twos, low threes, whereas those same lenders might be charging variable rates in the low twos or even as low as 1.89% with one lender at the moment who just dropped their variable rates earlier this week. So variable rates seem to be at the cheaper end in those sort of low risk loan scenarios where people have a little bit of equity, are borrowing 80% or less. If we're talking about a loan where you're borrowing, say, 90% of the property value, those variable rates creep up, and there are a few that are a little bit under 2.5%, maybe 2.24, 2.3, something like that, but most lenders are charging more like what their fixed rates are, high twos, low threes, if you're borrowing 90%. If you're putting them at a higher risk and by borrowing that sort of amount of money, then there's not that much difference between the variable rates and the fixed rates. So I've got a lot of people saying to me at the moment, can I fix in order to make sure I'm on a good rate before rates go up? I'd say that would have been a good question back in maybe July or August last year. Unfortunately now fixed rates have already moved up back to around where they were before COVID, or a little bit lower or a little bit higher. And so if you fix now, what you're actually doing is fixing a rate that is already effectively appears to be pricing in the variable rate rises that we're expecting to be happening soon. Variable rate rises have been talked about ever since rates dropped. One thing that I think is worth considering is that when the Reserve Bank dropped the cash rate down to 0.25 when COVID hit in March 2020, there was immediately talk about rates going up at some point. And then in November 2020, when the Reserve Bank dropped the cash rate again from 0.25 down to 0.1, there was more talk. And people are talking all the time about rates going up, rates going up, rates going up. The Reserve Bank has not put the official cash rate up since 2012, 2011, something like that, maybe even earlier, around the time of the GFC. The only thing the Reserve Bank has done with the cash rate since then is put it down. So it will actually be a pretty huge day in Australia's history, not to put too fine a point on it, when the Reserve Bank finally decides to put the official cash rate up again. I imagine when they do that, for mechanical reasons, they'll probably put it from 0.1 back to 0.25. I don't know, it's not my decision, but that would be the thing that makes sense. And then increments of 0.25 make sense after that, and maybe they do that again. But if you're getting 1.99% variable and then that happens, that's a jump of 0.4%. You'll be up to 2.39 if that happens. That's still a lot cheaper than what you can fix at for 2 or 3 years at the moment, generally speaking. So fixing isn't necessarily a solution that's going to get you a better deal over the next year or two. Really, to figure that out, you've got to predict the future, and I'm no better at that than anybody else. But I would say it's an interesting question at the moment. It's a hard one to figure out, and it's worth just talking through your individual situation and figuring out what you're trying to achieve, what sort of a time frame you're looking at, how much debt you think you can pay off over that time frame, whether splitting between fixed and variable is something that makes sense or not. And in a lot of situations, what I've seen in the last month or two is people making the decision to simply make the whole lot variable because it's just cheaper, and hope that rates don't go up too much. It's also worth just thinking about, if rates do go up a little bit, how much that will actually change your repayment by, it might not be as scary as it sounds. It might be scary, it depends on your individual situation, but I've spoken to a lot of people lately where once we look at what happens if the rate goes up by 0.5%, it's not as bad as they think. And in fact, the point I would make is rates, if you get 1.99% variable, rates would have to go up an entire percent just to get back to where they were before COVID, which everybody was fine with at the time. Everybody I spoke to anyway. So try not to get too caught up in the hype in the media about rates moving up. Rates are at the lowest they've been in history in Australia, and they're just going back to something a little bit more normal eventually, probably at some point. I hope that helps you think it through, but I'm also happy to help you think it through one-on-one and help you make a decision based on all of the available information at the time. Thanks very much.